Hi everybody, welcome back to another video. So in this video, I'll go through the recent earnings of Keppel Infrastructure Trust and Fraser Centrepoint Trust. Keppel Infrastructure Trust is a business trust while FCT is a REIT. Although they are quite different, we can analyze on each of their prospectus. Now let's get started with KIT's results. For those who are new to this business trust, it works similar to REIT in a way they give most of their distributable incomes as dividend to shareholders. Unlike REITs, they do not have the obligation to have leverage ratio and interest coverage ratio of at least 50% and 2.0 times respectively. However, it's important that they do not over leverage as it will cause the company to collapse. So if you go to their slides, like the naming of the trust, it contains a lot of different infrastructures. What I like about the current management is that they are very aggressive in acquiring new assets which are DPU accretive to the trust. It is very important that when the management acquires assets, it must be DPU accretive, which means that the dividends given to shareholders should increase from this purchase. So far, the assets purchased by KIT is good because they are utilities which are required at all times and tends to be stable. The only recent proposed acquisition is Ventura, which is a bus business that I'm not so sure if they can manage it well. That is one risk to take note when they are buying businesses which they are not familiar with. Next, this slide shows a lot of the management performance and commitment in increasing DPU for the shareholders. Ever since the new management from Keppel Capital took over, the dividends have increased with a huge bump last year with a special dividend due to value creation. Of course, the accretive DPU is subjected to a few assumptions, and please take note the special dividend is just a one-time off. For KIT, if I want to be more conservative, I will always assume the old dividend as we do not know how well the new assets can perform to give higher dividends. Like I said, I like the new management idea in aggressively acquiring new assets, and so far it has been quite decent. We will just have to continue observing closely as the risk of expanding too fast in the event the new business do not do well, KIT's dividend might drop. With the proposed acquired of the Australia bus business, DPU is expected to increase by 3.4%. We were supposed to be expecting an equity fundraising to be held where shareholders are offered to buy an entitled number of shares at a discounted price. But turns out they actually used their cash and took term loans in order to do the acquisition. The purchase is approximately 533 million while they hold 422 million cash. So they might take loans around 200 to 300 million we will see in the next quarter's results. I'm very surprised, but this might actually be a good move. With the recent low share price, they will have to issue more shares at an appropriate price to raise the similar amount of cash required. This would dilute shareholders more than expected. Therefore, I think the management made a good move by taking on term loans instead of issuing rights. This is important if you believe in this business. Buying at a low share price will definitely yield a higher dividend yield. Now, what is the risk of this business? For this bus business, 84% of the revenue comes from the government mass transit. If you look at the information clearly, the 8 years contract was already in effect since 2018 and will expire on 2026 with 2 years extension option to 2028. So this will be one of the risks for this business in the event if the Australian government do not want to renew contract with Ventura. Based on this purchase, I'm still cautiously optimistic that they will still predict a higher fund from operation and DPU, but the net gearing level will be expected to increase as they take on more loans for this purchase. Good thing is that business trusts do not have a cap in the gearing ratio. Therefore, as long as there are lenders that's willing to back up KIT, then it is safe to continue loaning. Of course, loaning too much in this high interest rate environment is bad, but I'm sure the management did the correct calculations before going ahead with this action. Another good news is that KMC Asset, which is the waste to energy plant, have managed to have an agreement with the government for the extension of the lease. This allows them to refinance the loans in this asset and resume distribution to shareholders for dividends. However, if you look at the distributable income, the value does not seem good, with income dropping 29.1% year over year. So we have to analyze it deeply. For Q1 of 2024, distributable income would have increased 29% year over year to 66.8 million due to large performance fee and upfront financing fee for the Philippine oil storage. Q1 of 23 distributable income would have been 51.8 million if the BKR2 debt payment was accounted for. So that's why for the renewable portfolio, the distributable income comes in at only a horrible value of 1.6 million, which is a 92.3% drop year over year. The drop is fine is because it was due to debt payments rather than a drop in the asset performance. Similarly, for the Philippine coastal, distributable income dropped 70.7% but was due to financing costs and growth capex of 3.3 million. One reason I suspect might be due to the bonuses given to employees as well as one-time off increase in capex for their assets. But we have to continue observing and hopefully next quarter will show better results. Next, looking at their debts, the leverage ratio for KIT is at 41.1%. It's not a big issue as long as they are comfortable in paying the debts. Unlike Reits, they do not have the leverage limit. Moreover, their interest coverage ratio of 13.8 times emphasize again on how strong they are in able to pay down the interest of the debts. Debt maturity wise, they do not have much that would be required to renew until the full financial year 2026. This will give KIT stability for their debts with these 2 years. Of course, with the strong sponsor supporting behind KIT, which is Keppel, debt renewals should not be an issue. At the current share price, it is giving a dividend yield of around 8.4% at semi-annual dividend basis. So if you have enjoyed and find my video informative so far, please support the channel by hitting the like, subscribe, and comment on what you would like me to talk about next. Thank you, and let's continue with the video. Next, let's go on to the next REIT, which is Fraser Centrepoint Trust. For those who are new to Fraser Centrepoint Trust, they are a REIT with properties purely in Singapore and the retail sector. What makes this so unique is that Singapore is a highly dense country. Therefore, shopper traffics tend to be higher in most of the malls as compared to overseas retail malls. One important note about REITs is the quality of the properties they hold. Based on this REIT, the properties that the sponsor, Fraser, gave is very good, as all these malls historically tend to have more shopper traffics. They have been growing actively with the asset under management growing by 2.3 times since 2018 to 2024. What I like about this REIT is that they focus on buying quality shopping malls and selling away the lower quality ones. They have purchased Waterway Point, interest in ARF Group which holds Tiong Bahru Plaza, White Sands, Hougang Mall, Century Square and Tampines 1. And they have also bought interest in a popular mall in Serangoon, and that is the Next. The lists are mostly good shopping malls, and they have divested away shopping malls which are not bad but not good as well. Looking at their results, revenue and NPI both came in lower year over year at 7.2% and 8.4% respectively. Main reason was due to the divestment of Changi City Point and asset enhancement at Tampines 1. Excluding those two, revenue and NPI would have been up. Good note is that their property expenses actually went down by 4.1% due to asset divestment. Normally, I would like the REIT to include finance costs in this high interest environment. Since they left a row for me, I guess I'll put in myself. Finance costs increased by 16.6% year over year, which is quite high and is definitely bad as REITs have to put more of their income into paying the interest of the debts. Even with the higher distributable income, their DPU still dropped by 1.8% year over year. This is common for REITs when there are more number of shares being issued. More units issued will dilute shareholders. Therefore, when the increase in units is more than the increase in the distributable income, the DPU will be lesser per unit. One of the easy ways to find is to search the keyword such as the company name and private placement or issue rights. For FCT, they have recently done private placement of 200 million. Honestly, I dislike this because only accredited and institutional investors are involved, while retail investors like us will not be able to participate. But it's okay, we will just have to live with it. For debt-wise, leverage ratio is decent at 38.5% and they have an impressive adjusted interest coverage ratio of 3.26 times. Why I say it's impressive is because at such a high cost of debt of 4.2%, they still managed to keep an interest coverage ratio of above 3 times. For Reits, having a high cost of debt is bad. But if they have a decent interest coverage ratio on top of the cost of debt, then it's fine because this means that the REIT can pay off the high cost of debt easily. Next, if we look at the debt maturity profile, there are 38% of the loans that are required to be refinanced within the next 2 years. Hopefully, with the high cost of debt already at such a high level of 4.2%, the finance costs would not continue to increase that much when they refinance. On the bright side, tenant sales and shopper traffics are coming in higher than 2023, with tenant sales in 2024 surprisingly doing very well. There might be a lot of factors such as the willingness of locals increasing their spending and increasing of the number of tourists that is coming to Singapore. All these factors will definitely benefit Fraser Centrepoint Trust. This is also boosted with the positive rental reversions across all properties with average of 7.5%. This is very impressive. Honestly, I've also enjoyed these malls and have seen a lot of shopper traffics. That's why we will expect them to continue to do well. Tenant diversity is also decent, with the only highest from the top tenant of 6.3% of their total income, and that is NTUC FairPrice. NTUC FairPrice is of course a very reliable tenant, while the rest of the tenants only takes about 3.5% and below. At the current share price, based on the recent dividend, is priced at a dividend yield of around 5.4% at semi-annual dividend basis. Honestly, with the possibility of the finance cost increasing, it will definitely pull down the dividends even if the malls continue to perform well. So as investors in REITs in this high interest rate environment, take note on what dividend yield is acceptable to you. Reason why a lot of REITs have their prices drop recently is because risk-free rates assets such as bonds and treasury bills are giving higher returns. This in turn expect higher dividend yield returns from more riskier assets such as REITs, therefore drop in the REITs prices. I hope this video is helpful. Please support the channel by hitting the like, subscribe and comment on anything that you would like me to analyze on next. You can also watch my previous analysis on 4 good REITs and on the 3 big banks in Singapore. Thank you, and I'll see you in the next video.